This is Daybreak Asia. We're counting down to Asia's major market opens. And Haidi, there's a few different stories in town today, but one of the main ones that we're going to be focusing on today is certainly the Bank of Japan. Are we going to see that first rate hike since 2007? And that decision is due at about 11 a.m. Tokyo time. Of course, the longer that it extends, it depends also on the fruitiness and the difference in their policy changes too.
That's right. Historically, it's been really interesting looking at the timing, of that sort of time plot, right? The later that decision comes, the more exciting potentially that could be. But we'll be watching that. We're also watching the RBA on RBA decision day as well, whether there's a softening of that hawkish bias, even though we're not expecting any kind of change or easing from the RBA just yet. But let's get straight to the markets on what could be a momentous day for Japanese markets, Belle.
Yeah, that's right. And as we said, it's that focus on what the BOJ does later in terms of their key rate, in terms of the program of yield curve control, the program for ETF, REITs buying as well. There's a lot of different things. The messaging we get out from Ueda in that presser later this afternoon, is this sort of a one and done scenario, or are we really changing off the back and setting a new course for the direction for rates? Certainly the strength of the wage negotiations is something that's been really heralded by the government, by economists that we've been speaking to, caught a lot of people by surprise. The question, of course, with that one is whether it trickles down from the large to the smaller enterprises here. But today, this is the setup that we're seeing, the Japanese yen holding fairly steady. You can probably expect it to stay in that sort of state ahead of the BOJ decision. But equities just a notch under pressure so far. They have been benefiting from a weaker yen. We'll see if that sort of trend continues, but lots of different areas and parts of the markets that could benefit from the policy shift, banks or brokerages. We've been talking about small cap stocks, just some of the things we're tracking here. Let's shift over, take a look at how Korea's coming online too. Don't want to lose sight of that market. The focus here today, again, a bit of weakness coming through, but we'll be tracking those tech stocks in particular because we had quite a bit of tech news overnight. Tesla saying they're going to be raising the price of some of its vehicles. You had news around Apple integrating possibly some of Alphabet's offerings into its iPhone, and then the new NVIDIA chip that's just been announced by the CEO Jensen Huang at their AI sort of conference or festival overnight, depending which way you look at it. But certainly we did see those big gains in big tech, Haidi, overnight.
Yeah, no big gains or no big losses either when it comes to trading in the equity session here in Australia on RBA Day. We're about an hour or so into the session. Some leadership being shown by energy and utilities. We saw oil holding that gain with those Ukrainian drone attacks on Russian refineries and the OPEC Plus supply cuts in focus there. So a little bit of upside there. But really, we are seeing quite a lot of caution being exercised here ahead of the RBA and the BOJ. This is a picture when it comes to Australian bonds. 10-year real yields rising about 1.8 basis points there from the previous day after a decline earlier in this month. But of course, we're continuing to watch to see whether the tone changes from Governor Bullock a little bit later on today. When it comes to the Aussie dollar, we're holding steady at 65.55. Alongside the yen, really the biggest trigger could potentially be how dovish does a Fed sound later on this week. Of course, the RBA decision is not expected really to fundamentally change the direction of how we see the Aussie trading, given the continued pressure that we see from metals prices, iron ore prices in particular, and that sustained weakness in the Chinese economy as well. As I mentioned, Brent crude trading just under $87 a barrel at the moment. Take a look at treasuries, really poised to move, regardless of really what the Fed does, right? Potentially at risk from what we hear on in that Wednesday meeting. But the two-year yield in particular is sitting at a 2024 high. We've had Goldman Sachs really resetting their outlook when it comes to the Fed. We see the 5-year actually climbing to the highest levels this year as well. Goldman's forecasting now fewer Fed interest rate cuts this year. So we're seeing some market implied odds of that June cut being repriced, Bill.
Yeah, it's really just that big central bank focus. But let's get to the highly anticipated BOJ decision that's coming up in just a few hours. And our Chief North Asia correspondent, Stephen Engel, is live for us outside the central bank in Tokyo. And Steve, so much anticipation, but also so much that's sort of been reported already, at least in local media. So is there any sort of surprise that perhaps could come today?
Well, the only surprise will potentially come in the press conference at 3:30 later today when Governor Haidi will meet the press and kind of give the rationale for whatever decisions that they do make, of course, which has been widely reported by the Nikkei and by other media here, sort of a foregone conclusion. Everybody I've spoken to, once the Nikkei and others have reported what we were also reporting yesterday. In addition, then, at 2 o'clock this morning, we got the report from the Nikkei essentially saying in addition to exiting the negative interest rate policy for the first time in 17 years, they're essentially going to also scrap the yield curve control, the YCC, as well as ETF purchases and also purchases of J REITs, which they haven't done since 2022. And of course, the ETF purchase program has been in place since 2010, I should say. So there is a significant change in the mechanisms for monetary policy that will be usher in significant change here and a boost of confidence as well. And clearly, Governor Haidi, he signaled that this was going to likely come at some point. When we were last year here at the end of January, we were thinking it was going to perhaps be April. But again, the Shunto wage negotiations that really culminated with the Rengo results on Friday, which were much higher than expected, essentially plays into Governor Haidi's narrative that he wanted to see a virtuous, sustainable cycle of inflation backed by wage gains. So clearly, if the reporting of the Nikkei and others is true, at midday today or thereabouts, we're going to get that decision to exit the negative interest rate policy with a likely hike in the short-term policy rate, a benchmark rate of by about 0.1% to a range of 0 to 0.1%. And that, again, would be the first hike in 17 years. So, yes, a fairly momentous day here in Japan.
Our Chief North Asia correspondent Stephen Engel there in a very cold Tokyo, hoping that the BOJ will turn up the heat later on today. But let's bring in Carl Brodder, who's a senior market analyst at Capital.com, with his views. And Carl, the question is connecting wage gains into sustainable inflation into a virtuous cycle where households are spending. Do you think that part might be a bit tenuous?
I think it's particularly tenuous, and it would seem to me that it could potentially be a policy mistake if the BOJ was to tighten policy from here. Of course, it's only fairly marginal. I mean, 10 basis points isn't huge, even if it is from negative rates into effectively, positive rates, as well as, what is going to be a fairly timely tweak to yield curve control, and perhaps an opportune one too, considering that, we're not really seeing the kind of upward pressure on yields that we saw last year in global markets. So it might be a slightly more orderly transition to do it now. But to sort of settle on the evidence as we've received it now, that we have seen that sort of stable, sustainable and virtuous cycle taking off in Japanese economy, that means that inflation's re-anchored at 2% after years and years of trying to generate that outcome, says to me that, again, there's either a policy mistake afoot, perhaps some incorrect economics on the basis of this, or even perhaps the Bank of Japan wanting to hike rates really on the basis to vindicate that it's actually got the job done. So at the moment, of course, we're lined up for a fairly significant policy change today, but my sense is potentially it's premature and could run contrary in the long run to Japan's economic outcomes and welfare.
You've not been partaking in this equity rally in Japan for better or worse, I guess, but do you think the move today, and I guess removing the currency aspect, is going to make a meaningful change in terms of whether we've seen the peak for this rally?
Yeah, most certainly. And I mean, to sort of peel it back, we were chatting a few months ago, and the comment that I made was that it's the quintessential soft landing trade, the Nikkei, and lo and behold, despite the fact that it seemed unlikely at times to get sort of the level of disinflation globally that we have seen, as well as resilient growth, that's exactly what's occurred, and as a result, the Nikkei has rallied. Now, though, we're seeing a situation which things are becoming a little bit more precarious. The depreciation in the yen and the stability that we've seen in bond markets has really been generated from international dynamics outside of Japan in particular. Of course, the United States and the soft landing, a resilient economy that we're having there, and again, what seems to be a slow process of disinflation. But now we're going back to some domestic factors in Japan, this sort of tighter policy which could potentially restrict financial conditions. And in saying that too, a level of complacency going into this meeting, because if you do look at rates markets, there's a 50-50 split that they'll actually hike by 10 basis points, which isn't fully priced in, and suggests that even though we've had this kind of move in markets over the last few weeks in Japan that have seen a little bit of weakness coming through the Nikkei, as well as some strength in the yen, that's been unwound because of a US dollar story, and isn't fully discounted again in rates markets. So on the basis of that, of course, like I said, I've been sceptical to start with from the Nikkei's rally, and wrong about that. Now it looks like it is a potential inflection point because of this unwind of this kind of soft landing trade. And because this isn't fully priced into the market yet, a firmer yen will almost inevitably lead to a weaker Nikkei. And it does suggest that maybe the top is in, at least in the short term, for Japanese equities.
What about equities in other parts of the world, and the US in particular? Because, as you said, you had thought that a soft landing was sort of an unlikely scenario. Perhaps that's now coming to fruition. We're getting these changing expectations around rate hikes and fewer rate cuts being priced possibly for 2024. But then you add to it things like NVIDIA, for instance, announcing a new processor or chip overnight. That could spur further gains, for instance, in tech.
Yeah, absolutely. And I mean, again, reflecting on where we started at least the year, I suppose we are getting to the end of the quarter now anyway, is that, you know, the really two things that drove this kind of market higher and sort of presented this big contradiction in the equity rally is that markets were simultaneously pricing in resilient growth in company earnings, while at the same time pricing fairly significant rate cuts, which would indicate, you know, a much weaker economic environment in the year ahead or so. Lo and behold, it would seem that we are getting that kind of resilience in economic growth, but as a result, markets are pricing out those rate cuts, and equities have been surprisingly resilient despite that. I think the core concern, and this is going into the Fed now, is that maybe policymakers and market participants have underestimated perhaps where the neutral rate is for policy, that maybe real rates at 2 to 2.25% in terms of real rates isn't sufficiently restrictive, and we're starting to see that kind of reflected in rates markets across the world, as well as a sort of lift again in bond yields to suggest that, again, effectively policy rates where they are now aren't sufficiently restrictive, and there will therefore be this higher for longer dynamic and maybe even some upside risk to rates going forward in order to bring, obviously, inflation back to target, knowing that over the last, say, 6 months or so, there is some evidence to suggest that it's re-anchored around 3%. So you add to the fact that, you know, we have this dynamic that equities have managed to rally despite this pricing out of rate cuts, and really it's been driven, like you noted, by this sort of AI mania and the news, buying into news and momentum off the back of this sort of news. It means that valuations look a little lofty in tech at the moment. We've already seen a pullback in the last few days as the market shifts towards potentially 2 rate cuts in the year ahead, but that could persist a little further, especially if policymakers as well as market participants reassess where neutral rates actually happen to be.
Just in the last few minutes, we've been getting an update on a Chinese developer, Sino-Ocean, and we are hearing from the company that they're still in the course of finalising their full-year results for 2023, but they are seeing a full-year loss attributable ranging from 20 billion to 23 billion yuan. How much further do we need to see the woes in the property sector continuing? How much has been priced in, and also how does that play into your outlook for mainland equities?
Well, this is one of those time frame questions because, I mean, I think if you look at in the short term, and this has proven true probably over the last month or so, there is a fairly strong opportunity for traders in Chinese equities in particular, really on the basis of very depressed valuations and technical factors, so a reversal of momentum. Not only that, I mean, I think the sell-off that we saw in February, which led the market to 5-6 year lows, depending on the index that you happen to follow, was really driven again by technical factors and a sort of simmering panic around financial stability as well as financial outflows, which to the credit of policymakers, they were able to curb quite successfully, take some risk out of the markets, and therefore we have seen this rally in Chinese stocks. Still, we're seeing technicals fairly favourable and valuations suggesting that some opportunities to the upside there. But I don't think what markets truly get in China is that effectively China remains very, very focused on its long-term objectives. Those objectives are things like deleveraging, decoupling, modernising its economy, re-establishing trade relationships and what have you. And those things can't be achieved if we start to see pump priming of the economy through either easier monetary policy or fiscal policy, which means that either one of those things have to be, the long-term objectives have to be achieved or abandoned before we see this sort of big bazooka policy, which will lead to a sustainable lift and removal of the country risk as well as regulatory risks that are plaguing Chinese markets. So again, in the short term, technicals and valuations are very favourable, but for allocating long-term capital, there's still significant risks risks associated with effectively putting money, long-term money to work in Chinese markets.
All right, that was Kyle Rodder there, Senior Market Analyst at Capital.com. As we head through the morning session, 15 minutes into trade so far for Seoul and also Tokyo, but that focus on what we're seeing this morning amongst some of the groups that could stand to gain from any sort of BOJ hike. Later today, of course, that's the expectation by traders, by economists, a lot of people that we're speaking to. But these names, they could be among the beneficiaries if we do, as I said, see that higher rate today, or an exit at least away from negative rates. But let's change on. There's another group of stocks we're tracking this morning, and these are the tech names today, because we did actually see the Magnificent Seven up around 2%, an index that we have at Bloomberg overnight, so about twice the gains we saw for the NASDAQ. We did actually see NVIDIA as well unveiling a new processor, so it's a successor to an earlier one that already had sparked so much intrigue and so many sales as well. A lot of focus on that name. But today in the session so far, big tech, a little bit weaker, Haidi.
Coming up, we get more market analysis of JP Morgan Securities talking through their Japan equity strategy ahead of the Bank of Japan's widely expected rate hike now. But first, more on China property. Evergrande accused of falsely inflating its revenue in the 2 years leading up to its failure. We have the details next. This is Bloomberg.
This is Hopper. Hopper changed the world. This is Blackwell.
That's the NVIDIA CEO Jensen Huang there, showing off the firm's new chips. And you can see, as he says, there's the H100 and then there's the B100. So the Blackwell is seen as the successor to the Hopper chip. Let's get more on this now and bring in our Bloomberg intelligence analyst who believes that NVIDIA's new Blackwell chips will drive another wave of accelerated sales growth for the world's third most valuable business. Our senior semiconductor analyst, Kunjan Sabani, joins us now from San Francisco. And Kunjan, I'm curious because there's just so much competition in this space. Not only do you have the H100 still, but you've got the likes of AMD, Intel, Meta, Microsoft, Alphabet, Amazon. These are all trying to create AI chips. This new B100, how much further is it ahead of the pack?
Well, it significantly widens an already wide performance gap that NVIDIA has versus its peers. The chip competition is trying to develop GPUs which sort of match the H100 or maybe slightly above them. And at this time, the company comes on with B100s, which are 2.5x better than the 100 platform. And it's not just the GPU, it's the surrounding upgrades to the networking stack and the higher memory, and it's the two die within the same package. So all of this results into a significant performance lead versus what's available today in the market.
In terms of the technology, how does it help transition, I guess, comparatively more simple AI tasks into what we see as the next generation of this technology?
I mean, essentially what it does is allows you to get the same kind of performance or workload with less number of chips and significantly less power, which is sort of what are the two bottlenecks right now, preventing these large models to even get larger and larger and become much more efficient.
Bloomberg Intelligence Senior Semiconductor Analyst Kunjan Sabani there in San Francisco. Let's get the latest when it comes to China's property crisis. And defaulted Chinese property developer Evergrande has been accused of falsely inflating its revenue by more than $78 billion in the 2 years leading up to its ultimate failure. Let's bring our Greater China Senior Executive Editor John Liu there in Beijing. And John, what do we know about these allegations?
Well, what we know is that is a shockingly large number. To give you some context, Evergrande is accused of inflating its 2019 revenue by about 214 billion yuan. That's about 30 billion US dollars. That accounted for about half of its revenue in 2019 and led to an exaggeration of profit by about 63%. And in 2020, the company is accused of exaggerating revenue by 350 billion yuan, which was almost 80% of revenue that year, and led to an exaggeration. This is the accusation from the CSRC, exaggerated revenue profit that year by 87%. And so you get a sense of how large this alleged fraud was. The CSRC putting the blame squarely on founder Hui Kai-yan, saying he directed people around him to do this, to recognize sales prematurely. We do not have a criminal charge against Mr. Hui yet, but I think that might be the next thing we'll get.
Yeah, as you say, it is that focus on when we do see any sort of criminal charges. But I'm curious as well, given there's that liquidation process, how does such an inflation of earnings impact that?
So as part of these allegations that were announced overnight, the CSRC is saying that the company sold about 20 billion yuan of bonds using these inflated revenue numbers as part of the marketing for those assets. And so obviously that throws into question the legal status of those bonds. I'm not a lawyer. I think these things are going to have to go through a lot of detailed discussions between lawyers and court. I think, if anything, it's very clear this makes it much, much more complicated for the creditors.
We're, 3 years into the property downturn and continuously still seeing these negative headlines. Is there sort of one developer that's going to be the back-breaking element here? Are we seeing much progress when it comes to market reforms and attempts to have policy steer out of this?
So I think the fundamental issue right now that's plaguing the industry is a lack of sales. People are not buying homes. We have a stockpile of inventory. The developers, the likes of Vanke, who has come under a lot of concern as of late. They've found it very difficult to sell their properties, and as long as they do not have money coming in, they're going to find it very difficult to pay off the debt that they have coming due, and that is going to continue to cause repercussions in the marketplace. It probably will also contribute to depressing current prices, and that again is likely going to discourage additional buying from home purchasers. And so it's a cycle that, as of now, it's hard to see a way to get out of this very easily.
Bloomberg's John Liu there in Beijing. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak, and Bloomberg subscribers can find that at Daybreak on their terminals. There it is, the first hike, a lift-off expected from the Bank of Japan today. Also, you can get the details on the Bloomberg Anywhere app. You can customize those settings so you just get the news on the industries and assets that you care about. This is Bloomberg. Range-bound trading characterising the first hour or so of trade for major Asian markets on BOJ decision day, on RBA decision day. We are expected that BOJ hike a little bit later on today, potentially also letting go of the ETF buying program as well. All of this could be a watershed moment for Japanese equities and the Japanese yen. We're seeing the Nikkei 225 a little bit softer by about 0.5% there. There are some concerns that with the additional help of a weaker yen, potentially that record-setting run for the Nikkei 225 and the top piece could potentially be at risk, or at least maybe we're seeing close to a peak. The cost be off by just about 1%. We're seeing not much action trading here in Australia ahead of the RBA decision. We are seeing a little bit of leadership in that market when it comes to oil, oil-related players, I should say. Some of the refiners and energy names gaining by about 1% on the back of some elevated crude prices. Kiwi stocks also looking pretty flat at the moment. But really the main news is going to be the Bank of Japan appearing set to raise interest rates for the first time, I should say, since 2007, when that meeting concludes in a few hours. Also potentially axing its yield curve control program. Let's head back to Steve, who's with us in Tokyo with our next guest. Steve.
You know, it might get tired cliche, but it is a momentous day here outside the BOJ, of course, as we're going to likely, again, according to all the reports from the Nikkei and others, see an exit from the 17-year-old negative interest rate policy, as well as potentially other moves, including essentially a scrapping of the yield curve control and also essentially scrapping the mechanisms of future ETF purchases and J-REITs. To dig into this more, let's bring in our next guest, Ria Nishihara, JP Morgan Securities Chief Japan Strategist. You also worked at the BOJ for some 15 years, and Governor Ueda was your professor back in college.
Yes.
So you know what's happening here. How momentous is this, and how should investors be positioning themselves?
Yes, I think, that especially after the strong outcome of the spring wage negotiation was announced last Friday, the triple changes by the Bank of Japan, the removing negative rates, the change of YCC forward guidance, and also stop new purchase ETF is, increasing. And for removing negative rates, there is an expectation from the market that Bank of Japan will return to the previous system, where they set that policy rate, interest rate for excess reserves at 0.1. So that's to control that short-term rate between 0 to 0.1%. And for after removing YCC, the amount of the purchase amount of JGB by the Bank of Japan will be in focus.
So what's it going to be?
Yes,
because that's going to be kind of the benchmark from here on out.
I would like to say JP Morgan's view is 5 trillion yen. This is per month. This is slightly below the 6 trillion yen. The 6 trillion yen is a number to maintain the size of the current balance sheet. So 5 trillion yen looks a little bit tightening policy stance, but this is in line with a reduced auction amount. So from JP Morgan's views, the 5 trillion yen will be the threshold to show Bank of Japan's hawkishness or dovishness.
So you feel it was time to essentially scrap the YCC because we're now in an inflationary environment, no longer deflation?
Yes, of course. And also JGB 10 years are hovering around 0.7%. So even removing YCC at this point will not bring big changes in the yield curve of Japan, JGB. And if I can make a comment on the ETF, Bank of Japan will likely to announce that stop of the new purchase of ETF. Again, since 2021, actually, they virtually stopped purchase of ETF. So the market impact should be minimal. And I believe Bank of Japan will not hint the market. They will sell their holdings. There are 2 steps. One step is stop new purchase. Second step will be that they will announce that decision of what they are going to do, their holdings, 70 trillion yen's ETF holding, which consists 7% of the total market cap.
So that is a significant thing. If they do come out and say that they're not going to be selling, they're going to be holding on to it, that should give a good indication to support for the market continuing.
Yes, of course, Bank of Japan, it would be difficult for them to say that, for the second step, because Bank of Japan will have to work with other policymakers. A market estimate is that they purge their holding to outside of Bank of Japan at some point in the future. So it's too early, but they can say that they will use that ETF dividend return from holding ETF to interest payment for excess reserve in a new normalized monetary policy.
Now, how should investors, what kind of guidance are you giving them? How should they position their portfolios right now, given the new normal, return to normalization?
I think, first, we'd like to emphasize that this, policy normalization is not just tightening policy. This is a process of good, structural changes in the economy. So I think even though there is a short-term position adjustment, especially from a stop of the ETF purchase, which could lead to a higher volatility, which could lead to a lower index, that sort of short-term adjustment cannot be ruled out. But having said so, I mean, the more important thing here is macro data supports these changes. We saw fourth quarter strong capex investment and January good wage data and good spring wage negotiations outcome. So this event should be seen as a positive, factor for the Japan equity as a whole by index. And
In your latest report, which was out yesterday, you highlighted the fact that between March 11th and March 15th, you met with investors in Hong Kong and Kuala Lumpur and Singapore who were considering, some of which were considering kind of taking profits from the gains in the equity markets here. Is that kind of be a short-term phenomenon, or do they see some of the things that you just highlighted, that this is a longer-term structural change and that there will still be some gains left to be had in the equity markets?
Yeah, so not a few investors in Asia stopping to consider about to take profit here of Japan equity or not, because they face that risk of unwind of the momentum trade year to date, not only in Japan equity but also global equities. So of course, going forward, there will be a time that investors will, face that similar situations. But we have to remember that in Japan had specific structural positive, changes now underway.
Yes.
So I would like to say that structurally there is a reason to see constructively on Japan equities, and we are now calling for it's time to look at especially consumption related stocks sectors, because of this strong wage guidance, it will likely to be followed by real wage starts growing, increasing, and that will be followed by increase of the private consumption. So that should benefit that domestic sector's name. And their earnings is good, but their stock performance was very poor. So there is a gap between stock performance and fundamentals.
So this is, you believe, a virtuous cycle of inflation backed by wage gains that will have lasting effects as long as they don't withdraw stimulus too fast.
Yes.
Right? That's what we're likely to hear. What do you hope to hear from Governor Ueda later today? He probably will not telegraph any future hikes.
No, I think, market consensus is Governor Ueda will make a very dovish remarks at briefing. So that, even after, making some changes in the policy, that is a way, actually, looking back in 2023. Whenever they make policy changes, they will cover with dovish remarks, and they make sure of this, the evolution of the economic changes. Especially private consumption is a key risk here. We haven't seen that strong private consumption yet. So I think before the Bank of Japan to ensure the recovery in private consumptions, that they cannot, show a clear indication of the rate hike.
Where does the yen factor in here? It hasn't moved much because of, the consideration that a lot of funds in the United States will not necessarily flood back in, because it's not a huge hike, obviously, by the BOJ, and there's still that gap on yields, of course. But do you see the yen still appreciating modestly, or what, over the next year or so?
I think the market has priced in the removing negative rates mostly, and we see 149 yen right now. So, the policy rate changes is very small, from 0.1 to 0. So that should bring a small, relatively limited impact on currency. And then the market already priced into the market. So I think any policy changes announcement today will not bring big changes on the currency market.
Okay.
Yes.
All right, Ria Nishihara, thanks so much for your time.
Thank you very much.
And we'll be watching everything very closely today. Sometime maybe around midday, we're going to get that rates decision. It's pretty much baked in that it will be a hike and an end to the negative interest rate policy here in Japan, the first time in 17 years. And we'll be right here freezing outside the Bank of Japan.
You'll be warmed up by all the excitement if we finally see a move from the BOJ. Stephen Engel there in Tokyo for us. And of course, we'll continue to head back to Tokyo with Steve to bring you the Bank of Japan rate decision as it happens. Instant analysis from former officials at the central bank will be coming up. This is Bloomberg. Take a look at how assets here in Australia are trading on RBA decision day. Really range bound. Not much of a movement at all when it comes to the broader equity session. Pretty flat at the moment as we're expecting the RBA to keep that cash rate at 4.35% for a third consecutive meeting. That 12-year high being held despite some weakness now starting to percolate through to the broader economy. We are seeing some leaders though. BHP is one of them when it comes to trading here in Australia. We're also seeing some oil majors and energy related stocks a little bit higher on the back of elevated oil prices. Watching though some of the miners though as we see iron ore resuming that retreat, a volatile start to the week as we continue to see that downside to demand in China, some of these negative property headlines continuing to weigh as well. We're seeing futures falling towards that $103 a tonne level in trading in Singapore. The Aussie dollar is pretty unchanged, 65.52. There is that broad view out there that when it comes to the Aussie and the yen, any kind of big move might have to wait until we get definitive signalling either way from the Fed later on this week. But the RBA widely expected to stand pat today as the economy continues to show some signs of slowing, particularly when it comes to trends that we've seen in the labour market. Let's bring in our economics reporter, Swati Pandey. So, Swati, for one, what are your expectations today?
So RBA is expected to stand pat, so 4.35%, which is a 12-year high. The big question is whether they keep their tightening bias. So last statement, they added this clause which said a further increase in interest rates cannot be ruled out. A very easy thing to do would be to just drop that clause altogether. The RBA is not known to make changes from meeting to meeting, so that's a big question mark. But data has been weak since their last meeting. So do they really want to signal to the market that they are still ready to raise interest rates when other central banks have kind of signaled they are at the end of the tightening cycle? So that's still a question mark. I think RBA is probably the only central bank, which is a major central bank, which is still has that hawkish bias intact.
And how much of that hawkish bias is it down to what we see in the property sector, do you think?
That is a big consideration. So we have seen house prices go up over 2023 when the Reserve Bank raised interest rates. So the housing market is basically very heavily driven by the huge population growth that we have seen in recent months. But also we have a very heavy supply shortfall, and they have both come together to drive house prices to record highs. So the Reserve Bank will obviously be very mindful of not further fueling that. But they also want to make sure that dwelling investment happens, and that will happen when they cut rates. So it is really a big policy dilemma for them.
On the geopolitical front, we have, of course, Foreign Minister Wang Yi's visit. In fact, he lands in Australia this evening, I believe. Is there a little bit more of a sort of relaxation when it comes to at least a trade relationship and how that's impacting the economy?
Yes. So even when trade relations were not very good, we still were selling a lot to China. Our budget position is pretty strong. Government has signaled that we'll have another second consecutive budget surplus. But it obviously it helps our economy, it helps our country a lot more if there are more Chinese tourists, there are more Chinese students, because they spend more in the economy. So and we have seen that number is still not fully back on to pre-COVID levels. So that would be if relationships improve and we once again start seeing more international students and more tourists in our country, it will definitely help the economy.
That was Bloomberg's Swati Pandey there. And just taking a quick look at how markets are faring so far in the session, it is that big focus on Japan, of course. Countdown to the BOJ rate decision, and we could be seeing the first hike since 2007 in just a couple of hours from now. But this is the outlook for Japanese equities over the session today. They are looking fairly mixed so far, but tilted to the downside. We have seen, of course, stocks really rallying over the course of this year, but part of that has been predicated on dovish BOJ policy. So question marks of whether we'll start to see that rally extending if we do see a hike today. In the lead there, though, is what we see in the energy space, and overnight as well, it was that story around oil, because we've seen it holding on to its gains, and it is that focus really coming down to the supply dynamics that are in the market here. So that is what we see for Japanese equities, as we said, heading through the morning session. We'll have more ahead. This is Bloomberg.
We are seeing energy stocks showing a little bit of energy, I should say, and also a bit of leadership across that sector, as we have broadly a little bit of trepidation across such a major day of central bank decisions, both in Japan and here in Australia. We're seeing Brent crude holding just under that $87 level, holding that gain as we see those continued Ukrainian drone attacks on Russian refineries. Also watching the impact of the OPEC Plus supply cuts are in focus there as well. We saw that almost 2% rally on Monday as well, taking it to its highest close since late October. We've seen about 600,000 barrels of Russia's daily refining capacity being knocked out by the strikes, according to Gunvor Group. And in fact, JP Morgan Chase saying that number is higher at about 900,000 barrels. So the impact there of geopolitical developments very much at play when it comes to trading in crude markets at the moment. Also watching natural gas, we're seeing upside of about 0.8%. US nat gas futures rose in that session as well. Some of the forecasts coming through for cooler weather indicating more potential for a late season bump in demand for nat gas, of course, used as a heating fuel. We're seeing stockpiles about 37% higher than the 5-year average, though, as we see that unusually mild winter has dampened use, but that could potentially change. We're seeing some of the energy names trading a little bit higher in the session as well. And also getting the latest when it comes to geopolitical headlines that we're following. Commodity trader Gunvor Group talking about those Ukrainian drone strikes knocking out about 600,000 barrels of Russia's daily oil refining capacity. Recent drone attacks hitting multiple plants in Russia, sending diesel and gasoline futures higher. Gunvor was a major trader of Russian petroleum before the invasion of Ukraine, but retreated from that trade not long after the conflict began. President Biden has warned Israel's Prime Minister that a major ground operation in the southern Gaza city of Rafah would be a mistake. Biden spoke with Benjamin Netanyahu by phone for the first time since mid-February, with the two agreeing to talks in Washington about Israel's war plans. The White House says the U.S. expects Israel to hold off any ground invasion of Rafah until those talks happen later this week.
Well, in Hong Kong, the new security bill is moving closer to being passed by the city's Legislative Council as the government seeks to fast-track laws giving authorities wider tools to minimise dissent. For more, let's bring in our Asia government and economy correspondent, Rebecca Chung-Wilkins. And Rebecca, this has been called one of the most significant, or the most significant piece of criminal law legislation since the 1997 handover. What are we expecting today?
Well, this has been fast-tracked, and that has perhaps been the defining feature of the process in which this has happened. If we do see it sort of fully passed today, it will have happened in essentially less than or about 50 days since it was first introduced. So today we are expecting a second reading. That will kick off this morning. I believe that meeting is kicking off at 9, in fact, today. And then that will move straight into the third reading, and then the bill, if all goes to sort of plan as we expect, the bill will be passed. So it has been very, very fast. Today is another opportunity, though, for lawmakers, about 90 lawmakers that there are in the Legislative Council, to give their feedback and to discuss and debate some elements of the bill. But really, I just cannot stress how quickly this has happened. Typically, this process would take weeks or months. Sometimes a bill of this complexity would really take years to actually come into force and go through all of those procedures.
What's been the response from the business community?
Well, I think to some extent, some of the elements of Article 23 have been a sort of lived reality, given the similarities in some parts between Article 23 and Beijing's national security law that has already, of course, been passed and that businesses have already sort of gotten used to. I think that there is an element of this sort of frustration among some members of the business community that Hong Kong is still talking about national security. That, of course, has drawn scrutiny and some criticism from other governments as well as from other parts of the world because, of course, of the geopolitics of this whole dynamic too. So if you think back to the American Chamber of Commerce survey, the 2/3 of respondents were saying that they want the US but also the Hong Kong government both to just move on and stop talking about national security. That was their top reason that they think that would help improve ties between the US and Hong Kong as well.
As you said, the hallmark really has been speed, but do we know why or get a sense of why there is this rush, given there is that business impact as well, at least the perception impact?
Well, we don't know sort of explicitly, but I think there's sort of two dynamics that we can at least point to. The first is that it does appear that John Lee and various delegates at the National People's Congress, that's China's annual parliament, appeared to rush home to come back to try and speed this through. So it does look like there was some kind of directive perhaps from Beijing to kind of get this done. And the other element is, I think, that element that I touched on about the business community. I think there is a desire for Hong Kong to move on from this and to get on with the business of, being an international financial centre, whether they like it or not. And Article 23 has drawn this scrutiny, it has drawn sort of criticism over Hong Kong and not necessarily shed it in the best light. And so I think there is a desire to sort of get the ball rolling with other economic priorities.
All right, Rebecca Chung-Wilkins there. We will, of course, be tracking that meeting as it kicks off in just a couple of minutes from now. But that's it from Daybreak Asia and our markets coverage that also continues.